Imagine placing an order today for a single piece of equipment, like something that is absolutely critical to keeping your entire business running.
Right.
You sign the purchase order, you have all the capital ready to go, and the vendor just looks at you and says, well, great, we'll deliver this to you in late 2029.
Yeah, 210 weeks from now. I mean, it sounds like a joke,
They
right?
do.
Or maybe, a massive supply chain failure from the peak of the pandemic.
Exactly.
But that is the actual current upper end lead time for a large power transformer right now. 4 years.
Wow, 4 years. And, that single data point really tells you everything you need to know about the hidden fragility of the systems we all rely on.
It really does.
You might look at the surface of the business landscape and think, oh, things are relatively stable.
Mm-hmm.
But the foundation you're standing on is entirely realigning.
Absolutely.
So, welcome to Sustainability Soundbites, a deeper dive. Yeah. This is a brand new segment where we go in-depth on the crucial topics we've been covering over the past quarter.
I'm really excited for this one.
Yeah, me too. Our mission for this session, we are basically unpacking a massive stack of recent risk and energy briefings just to extract the actual actionable takeaways you need for your Q2 planning.
Because when you look closely at the data from Q1, the overarching theme wasn't chaos.
Right.
It was convergence. I mean, we are seeing energy markets, capital flows, regulatory posture, and infrastructure constraints all suddenly pointing in the exact same and honestly somewhat unsettling direction.
Yeah, unsettling is a good word for it. We're going to navigate the realities of energy grid sequencing delays, dive into this massive structural misalignment happening right now in corporate procurement models.
Which is huge.
Oh, it's everywhere. We'll also look at the ticking clock of the July 2026 solar tax credit deadline and unpack why the smartest companies are making a massive shift toward what's being called strategic optionality.
Right. But I think we really need to start with the macro numbers driving this entire convergence.
Let's do it.
Because, if you look at the headlines, you might think the core issue out there right now is a lack of investment or, I don't know, a lack of desire to build.
Sure.
But it isn't. The real issue is a massive structural traffic jam on the physical power grid.
Yeah, let's look at the sheer scale of the demand first, because the projections here are just staggering.
They really are.
The Energy Information Administration, the EIA, they're now projecting U.S. electricity consumption to hit a record high of 4,268 billion kilowatt-hours in 2026.
Wow.
And then it jumps again to 4,372 billion in 2027. We are talking about the electrification of pretty much everything.
Everything. Vehicles, heating, industrial processes.
Yeah, all of that colliding with the massive energy demands of reshoring manufacturing, these huge new AI data centers.
Right. And you really see the strain when you zoom in on specific grid regions. Take PJM, for example.
Right.
For those who might not live and breathe grid infrastructure, PJM is the regional transmission organization that coordinates the movement of wholesale electricity across all or parts of 13 states in the eastern U.S.
So it's massive.
Exactly. They serve over 65 million people. And their latest forecast shows winter peak demand growing by 4% annually over the next decade.
4% every year compounded. That is massive.
Yeah.
That means they have to add 67,000 megawatts incrementally by 2035 just to keep the lights on during winter storms.
Yeah.
When electrified heating systems are pulling maximum load.
Exactly. And that brings us to the traffic jam itself.
Right.
The Federal Energy Regulatory Commission, or FERC, they currently have a backlog of over 10,000 active interconnection requests.
10,000.
10,000. That represents more than 2,000 gigawatts of capacity. And it's mostly new wind, solar, and battery storage, just sitting there waiting for the green light to connect to the grid.
Let's pause there, because I think it's really easy to hear the phrase interconnection backlog and just picture like a stack of paperwork sitting on a bureaucrat's desk.
Right, like red tape.
Yeah, red tape.
Yeah.
But it's a deeply physical and engineering-based problem, isn't it?
It absolutely is. The grid was, it was originally built around massive centralized power plants, coal and gas facilities that provided steady, totally predictable power.
Right.
Now we are trying to connect thousands of decentralized intermittent power sources. So when a developer wants to plug a new 100 megawatt solar farm into the grid, engineers actually have to conduct exhaustive sequential studies.
To make sure it doesn't break anything.
Exactly. They have to ensure that pushing that new power onto the existing wires won't overload the system or cause a cascading blackout.
Right.
And because the studies are sequential.
Meaning one after the other.
Right, meaning you have to understand exactly how Project A affects the grid before you can even begin to study Project B. So the queue just grinds to a halt.
Man. Meanwhile, the capital side of the equation is moving at light speed.
Right.
You might look at this backlog and think investors are just running away.
But they aren't.
Not at all.
Uh-huh.
U.S. energy transition investment just hit $378 billion, which is up 3.5%.
Yeah.
Grid investment specifically rose to $115 billion. And U.S. corporate power purchase agreements, PPAs, hit a record 29.5 gigawatts. Like, the money is definitely there.
It is. What's fascinating here is that the nature of that capital is shifting. What the sources show is that capital isn't retreating, it is filtering.
Okay, what do you mean by filtering?
Well, the money is flowing very selectively toward contracted revenue models and transmission-enabling infrastructure because the fundamental risk for your organization is totally shifted.
Right.
The big fear used to be pricing risk, like will power get too expensive?
Yeah.
Now, the ultimate threat is sequencing risk. Your internal math could be absolutely flawless, your funding could be secured in the bank, but your facility expansion stalls out entirely because the local utility simply cannot get you the power on your timeline.
Okay, let's unpack this. It sounds like having a fully funded, fully permitted, state-of-the-art skyscraper.
Okay.
But the city tells you it'll take 5 years to pave a road to the front door. You have the money, you have the asset, but you fundamentally do not have the sequence.
That is exactly the dynamic. That's a great way to put it. And that sequencing gap between having the capital ready and the physical infrastructure being delayed, it's causing absolute havoc inside corporate structures right now.
I do want to push back on that a little bit, though.
Sure.
Because if this FERC backlog is, public knowledge and grid constraints are in the news literally every day, why is it causing internal havoc? I have a hard time believing that entire procurement and compliance departments at Fortune 500 companies are just oblivious to this. Like, why hasn't everyone sounded the alarm?
Well, it's not that they're oblivious. It's because of a deeply ingrained structural misalignment in how corporations buy power.
Yeah.
They're just looking at the wrong dashboards entirely.
Got it.
Procurement models are built on 3 legacy assumptions that, used to be true but are now deeply flawed.
Let's go through those.
So the first assumption is that securing pricing secures availability. The second is that regulatory progression is linear-like, that rules change slowly and predictably.
Right.
And the third is that supplier disruption will mostly be cost-based, meaning raw materials might get more expensive rather than capacity-based, where the power simply isn't available at any price.
So really, the core failure is treating energy as a financial exposure first and a physical dependency second.
Precisely.
Yeah.
If you look at how a CFO's office operates, they manage energy by reviewing forward curves.
Which are basically financial projections.
Yeah, projections of what electricity will cost in the future. And they buy financial hedges to protect against price spikes. They view a signed power purchase agreement as a successfully mitigated risk.
So the financial approval precedes the infrastructure certainty.
Exactly. But a legally approved PPA on a spreadsheet does not magically force electrons through a congested transmission wire to your factory.
Wow, okay. This creates a massive internal blind spot.
Huge.
You've got the CFO looking at a hedged financial contract saying risk mitigated.
Yeah.
You've got the chief sustainability officer looking at the exact same contract saying emissions targets achieved.
Right.
They are both patting themselves on the back, but neither of their models accounts for the physical reality that the grid connection might be delayed by 3 years.
Yeah, we call that coordination risk. The silos inside the company are using entirely different definitions of what success actually looks like.
That is terrifying.
It is. And the compliance teams, they have their own blind spots regarding that second flawed assumption linear regulations. Compliance models typically treat regulatory frameworks as incremental. You get a new rule, you have a year to phase it in, it's very orderly.
But the sources are pointing to something much more aggressive right now, aren't they? Like a non-linear regulatory expansion.
Right. We are seeing federal actions suddenly reclassifying entirely upstream supply chain nodes as strategic infrastructure.
Wow.
Yeah, things like agricultural inputs and critical mineral mining are suddenly being treated with national security level scrutiny. That doesn't happen linearly. It shifts the entire compliance perimeter literally overnight.
So if relying on the macro grid's timeline is this risky and your internal procurement models are this misaligned, it feels like the only logical move is to take matters into your own hands.
Exactly.
If you can't rely on the road to your skyscraper, you basically have to build your own localized power system.
Which is exactly why we are seeing a massive surge in on-site generation. But There is a ticking clock attached to the strategy, and the window is closing rapidly.
Oh, let's talk about the July 2026 deadline.
Specifically, July 4th, 2026. That is the hard deadline for projects aiming to maximize their federal solar investment tax credit, the ITC.
Okay.
To capture the highest tier of that financial value, organizations need to understand exactly where their projects sit regarding the IRS's safe harbor and commence construction requirements.
And just to clarify for everyone listening, safe harbor doesn't mean the solar panels have to be fully operational and like generating power by July 2026, right?
Correct. The IRS rules dictate what constitutes starting construction to qualify for the tax credit. Usually, you either have to incur a certain percentage of the total project cost, say 5%, or begin significant physical work by that date.
Gotcha.
But because lead times for equipment are so long right now, hitting that 5% safe harbor threshold actually requires ordering equipment today.
Which changes the math significantly.
Very much so.
And we aren't just talking about slapping a few solar panels on a warehouse roof for some good PR anymore. The briefings show that solar plus storage is now a genuine, heavy-hitting financial asset. Corporations are reporting up to 30% reductions in their peak energy costs when they pair distributed battery storage with their solar arrays.
And the mechanism behind why it saves 30% is really crucial to understand.
Yeah, break that down.
Utilities charge commercial customers not just for the total amount of energy they use, but for their peak demand. That's the maximum amount of power they draw at any single moment.
Right.
So if you have battery storage, you can draw from the grid when power is cheap, store it, and then run your facility off the battery during peak hours when the utilities rates skyrocket. Grid congestion is now a structural pricing input, not just some episodic risk.
Here's where it gets really interesting because the technology is evolving way beyond just localized savings. The sources are highlighting the rise of virtual power plants, or VPPs.
Yes. We are seeing incredibly sophisticated VPP deployments in places like South Australia and California right now.
Help us visualize a VPP because, the terminology can get a little abstract. The way I read it, it's almost like decentralized cloud computing, but for electricity.
Oh, I like that.
In cloud computing, instead of relying on one massive mainframe server, you network thousands of smaller servers together to pool their computing power. So instead of buying a backup generator that just collects dust until a storm hits, your storage is basically working a side hustle, making you money by stabilizing the local grid. A virtual power plant networks hundreds or thousands of distributed solar and battery systems across homes, businesses, and factories, and aggregates them into a single, massive energy resource.
That's a fantastic way to think about it. The software aggregates all that distributed storage and allows it to function as dispatchable capacity. It actually rivals the output of mid-scale natural gas plants.
Which is incredible.
It really is. So your corporate battery storage isn't just acting as a defensive measure against peak pricing or blackouts anymore. It becomes an active grid asset. During a heat wave, the grid operator can digitally tap into your battery network, pull that stored power to stabilize the local grid, and actually pay you for it.
So idle backup power becomes an active revenue-generating asset. But to go back to the ticking clock for a second, the gap between we still have time to figure this out and we miss the window to capture the ITC benefits for these systems is closing significantly faster than typical corporate capital cycles allow for.
Yes, that is the danger zone.
Executive teams really need to make the ITC deadline an active, prominent variable in their financial models today. I mean, if it takes your board 6 months to approve a capital expenditure, your runway for 2026 is basically already vanishing.
Which requires a massive shift in executive mindset. To survive these grid delays, hit these deadlines, and successfully deploy localized power, companies really have to abandon a decade of conventional business wisdom. They have to shift from a philosophy of optimization to a philosophy of strategic optionality.
Let's dig into that shift, because the strategy over the last 10 years has been all about optimization, right?
Absolutely.
Just-in-time supply chains, lean manufacturing. The goal was to remove all the slack, tighten capital cycles, and zero out redundancy to maximize pure efficiency.
And that model worked wonderfully as long as the underlying constraints were stable.
Right.
If you knew exactly how long shipping took and exactly when the grid could give you power, efficiency was king. But the constraints just aren't stable anymore.
Which brings us right back to the transformer statistic we opened with.
Exactly. When lead times for critical infrastructure stretch to 210 weeks, you simply cannot procure your way out of a disruption.
You just can't.
If your highly optimized lean facility has a catastrophic failure of a transformer, or if the local utility says they can't meet your expansion needs for 3 years, you cannot optimize a 4-year wait list. The redundancy has to already exist within your system.
But I can hear the CFOs listening right now asking, wait, what does this all mean for the bottom line? Doesn't optionality just sound like a fancy business word for wasting money on slack and inefficiency?
It's a fair question, but if we connect this to the bigger picture, it's not about general inefficiency at all. It is about the highly disciplined identification of single-point failures.
Okay, what does that look like?
Well, what does layered procurement actually look like on a balance sheet? It means you don't sole source your power. You invest in on-site generation, plus battery storage, plus your grid connection, and you build the software capacity to dynamically switch between them.
So you're intentionally buying flexibility where rigidity would basically destroy your operations.
Exactly. In this environment, carrying theoretical infrastructure access on your balance sheet, meaning you just assume the grid will be there when you need it, is a massive, unnamed financial risk.
Wow.
The new competitive advantage isn't being the most streamlined, it is preventing forced decisions under stress. You are using modular build sequencing, so you can scale up or scale down your operations based on what the physical constraints actually allow.
That makes a ton of sense when you map it out like that. And to prove that this shift toward optionality and navigating this expanding regulatory environment is already happening in real time, we should slow down and look at the actual signals from our sources this week.
Yes, let's look at the real world.
Because these are real-world global examples of companies acting on the exact risks we've just discussed.
Let's start with how companies are managing grid stress. Toronto Hydro just secured 12 megawatts of demand response capacity. And what's crucial here is how they are doing it.
Right.
They aren't just sending out emails asking factories to voluntarily turn off their lights. They are operationalizing distributed real-time load flexibility. They have contracts in place to digitally curtail specific industrial processes for short bursts when the grid is peaking, compensating those businesses for providing that flexibility.
That's so smart. And you see a similar dynamic playing out in the transportation sector, too.
Yeah.
Energy Hub and Rivian are teaming up right now to expand managed EV charging across North America.
Oh, yeah?
But again, look at the mechanism here. The goal is to specifically align electric vehicle charging load with real-time grid conditions.
Right.
The software talks to the grid, and if the grid is strained, the EV automatically pauses its charge until the stress passes. It completely proves the narrative shift we were talking about. EVs are no longer just an adoption story. They are active, coordinated grid tools.
And we are seeing this exact kind of optionality happening at the heavy industrial level, too. In Portugal, you have a consortium, Bleiden, EDP, and Greenvolt, building a 49-megawatt peak solar plant at an active copper and zinc mine.
Wow.
And this is meant entirely for self-consumption.
That is massive. Decarbonization is happening directly at the industrial extraction level. Obviously, that hits their emissions targets.
Yeah.
But based on everything we've talked about today, the real strategic play is reducing their exposure to the fragile physical grid, right?
Yeah.
They're basically buying their own certainty.
Exactly. We also need to look closely at the compliance and regulatory signals we flagged earlier. The sources show that OSHA inspection rates actually declined over the last quarter.
Which, on the surface might sound like a collective sigh of relief for compliance teams. You look at that number and think the pressure is off. But the briefing explicitly flags this as a shift in enforcement strategy, not a retreat. And just to be clear for the listener, we're just looking at the data here, not endorsing the policy one way or the other.
Right, exactly. We're just looking at the facts. Because when you look at why the inspection frequency drops, it reveals a deeper risk. The data suggests that regulatory bodies are moving away from quick, surface-level walkthroughs.
Okay.
Instead, they are concentrating their resources. When enforcement does occur, it is escalating into much deeper, targeted, multi-day audits. So relying on a lower frequency rate to model your compliance risk is incredibly dangerous.
It's that nonlinear regulatory expansion again. And we see it in land use as well. The briefings track how the regulatory perimeter is expanding regarding federal land. Currently, oil and gas leasing near national parks is facing intense legal challenges over environmental impact and resource management. And again, regardless of where you stand politically on the policy itself, for any executive team whose operations, permitting, or supply chain assumptions are tied to federal land access, this is a glaring signal. The jurisdictional authority is stretching.
It's happening everywhere you look. Every single one of these signals, from the Canadian grid to Portuguese mines to U.S. federal land policy, it perfectly validates the structural changes we've been tracking today.
Absolutely.
The gap between what looks clean and resolved on a financial spreadsheet and the messy physical reality of infrastructure is closing incredibly fast.
It really is. Energy availability, infrastructure sequencing delays, compliance assumptions. These are no longer theoretical risks to model for 5 years down the road. They are hard operational constraints dictating what you can and cannot do today.
So as you sit down with your teams to map out Q2 and beyond, you really have to bridge that gap between the financial projections and the physical reality.
Well said. To wrap this up, we want to leave you with one final thought to mull over as you evaluate your own organization's resilience.
Consider this scenario. If your closest competitor is actively stress testing their infrastructure models today, preparing for the harsh realities and constraints of 2026,
Right.
and your team is still utilizing procurement models optimized for the stable, highly efficient supply chains of 2019, what happens to your market share when that 4-year waitlist for a power transformer suddenly becomes 5?
Man, a deeply uncomfortable question, but one every executive needs to be asking right now. If you have questions about being a part of future segments or other partnership opportunities, reach out to a member of our team today. Links are located in the body of this session's description.